All right. What a great intro. Great to be here, folks. Monday, July 20th, 2020. Just like my vision. I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tetrault Wealth Advisor Group. Thanks for joining us today. Really excited about our guest. I'll bring him in right away here. But before we do that, no, you know what? I want to bring him right away. We just saw the disclaimer. We'll bring in our guest right away. Today, we have none other than Scott Chan. Scott, let me bring you in here right away. There we go. Scott Chan, MBA, CFA, Managing Director, Equity Research, Financial, specifically stocks, the guy who here at Canaccord Genuity focuses his research, his livelihood on studying the financial companies and a couple others that some wouldn't consider financials, perhaps at some other firms. But we are thrilled and lucky to have you here, Scott. Welcome to the show.
Thanks, Rob, for having me. Appreciate it.
All right. So bit of a good day in the markets today. I always start the show every day. Maybe before I do that, I should say that if you're watching on YouTube, please take a sec to subscribe to our channel. If you're watching on Facebook, take a second, follow our page. If you like what you're seeing, share it, send it to your friends, tell everyone that you're watching the Tetrault Show. We're always thankful for viewers and for fans out there. We do appreciate all your support. So today in the market, NASDAQ jumps more than 2%. I'm just looking at my big board here up above the TV. The Dow, the NASDAQ future, the NASDAQ finished up almost, what's my latest number here? 263 points, 10,767, up 2.5%. The S&P 500 up 27 points, closed just over 3250. The Dow Jones up 31 points, closed just over 26,703. That NASDAQ, Scott, keeps hitting. This is an all-time high, 10,767, I believe, for a close, or near it for sure, if not. Are you surprised to see these kind of movements midsummer when there's no real kind of big news happening?
Well, I think people are looking to what's working, right? From a technical basis, and technology stocks and software stocks in particular, they've really thrived in COVID. So, you know, looking out, I think investors are really investing in what's working, and that's continuing on into the summer, Rob.
What isn't working, definitely some of the employees over at Southwest, Delta. I know 17,000 Southwest employees today, they signed up for buyouts, leaves of absences. This is a travel, basically no one's traveling. This week, actually, I saw a chart on CNBC that was reporting that travel is down. Airplane travel is down week to week for the first time since COVID kind of started. So we had seen kind of a nice trickle up. We're getting about 800,000 travelers a day, and that's down from the 2.5 million or so generally around this time of year. So travel is about a third, and those airline stocks are just getting hammered really bad, beat up pretty bad. Other headlines that we're seeing, Oxford and AstraZeneca. So they got a COVID vaccine. Not sure if you saw this news, Scott, but it showed a dual immune action. So last week we had the Moderna news. Now AstraZeneca, Pfizer, Merck, they're all kind of working on trying to get some vaccines going. It is a race, and this is the latest in a good news, which I think personally has spurred the market here these last 3 weeks. The thought of a vaccine. Would you agree with that comment, that you think it's moving the market a little bit?
I 100% agree. Headline news on COVID and finding a drug is paramount to the market and is a market moving indicator. I wake up every morning well before the markets open, so I was reading that today too, Rob, before I came into the office. But yeah, certainly that is positive, and is always incrementally positive during that day.
Your office, tell me about it. You're in downtown Toronto right now?
I am in downtown Toronto.
Right at the corner of Bay and Front there?
Bay and Front Street. It's a ghost town downtown for the last 4 months. Even right now, I would say in our office, in our floor, it's less than 10% capacity. I've typically been at home, like most people in research, during the pandemic, but I periodically come in to see my associates, and I had a company reporting People's Corp this morning, so it's just easier when you're in the office to work on companies.
People's Corp, a Winnipeg story. I know some of the people over there. Fantastic story. We're going to talk about it in a sec because it is a Winnipeg story. Are the street meat vendors out in Toronto? Can you go down and get a hot dog, or they're not even out?
No, not even out. The only thing that's open downstairs is Subway.
And I own, that's what I had for lunch.
I own a condo on the east side, just across the street on the east side of Yonge. And the only thing that's open, Rob, is Subway, and then now some bars over the past week and a half, but just on patios.
Okay.
Yeah.
The other headline that I saw that I think is a little interesting, it's a BNN Bloomberg report. Patty Lovett-Reed is quoting a study that says Canadian consumer debt fears are easing. And this is a survey. It's an MNP poll published Monday, reveals that various forms of government support has kind of eased the tension on personal consumer debt. I was a little surprised to see that because I thought, given the unemployment numbers that we're seeing, still, 10% of people without a job, that you wouldn't see this positive numbers. But I guess it has turned a little bit.
Yeah, I think it's more of a temporary thing. I think during this pandemic, Rob, a lot of people are just more cost conscious, right? They're not going out. Well, they haven't been able to go out. They're saving more pennies. They're not going on vacation. They're watching more Netflix, and Netflix is $12 a month. So, I think that's more of more on the consumer, just being a lot more cost conscious during the pandemic.
For me, I noticed I cut my cable, but I got Amazon. I got, or what's it called? Amazon Prime Video. I got Netflix. I got Disney, and I got Crave. I got the TSN package. Is that it, or is there another one? That's five, for sure, 5 different kind of $10 a month subscriptions that I got now, ever since I cut my cable. But I digress. I barely watch it, but it's still a good time. Let's get right into financial, Scott, because this is your area of expertise. I'm going to maybe ask you, before we get into any specific topic, overall, what are your thoughts about financials, Canadian financials thus far in 2020?
Yeah, so Canadian financials in 2020 has underperformed from a stock basis. As you know, financials are leaders in the market. So whenever there's a pandemic or a black swan event like this, or a recession, financials are going to underperform. If we do get out of this sooner rather than later, which is hopeful, we think financials will relatively outperform. So from a share basis, financials have been one of the worst performing sectors this year. Alongside active, and you look at the track record of the big 6 Canadian banks over the past 3 decades, they generally outperform. So a buy and hold strategy always works. And my job is to look at these nuances, and to a certain extent TD. And I'm just talking about a relative basis relative to its peers. They're more defensive names, and the banks that have been hit the most are the more risky names that we put in a bucket, and that would be like the BMO, the Bank of Nova Scotia, and the CIBC. On the regional bank side, Canadian Western Bank is exposed to Alberta, so they've had issues there, more sentiment issues with the drop in oil prices. And Laurentian Bank has been a troubled bank in Quebec, and they cut their dividend last quarter by 40%, and they're just losing market share. And a lot of these big 6 banks are attacking Quebec and seeing that opportunity that Laurentian Bank has or had in that market,
trying to snag some market share from Laurentian. Are we seeing the same thing out west with the CWB? Are banks going after kind of the clients of CWB more aggressively?
No, it's quite the opposite. I mean, in Alberta, the biggest company there is ATB. Canadian Western Bank is about half the size. A lot of the banks have pulled out of Alberta. Well, not pulled out of it, but pulled back because of energy. And you can kind of look at the energy loan books from the Canadian banks. If you go back to 15-16, Rob, during the last mini oil recession, all the banks' energy books were higher than where they are today. And they've got more upstream in terms of going to more production, more investment grade. So they've just been a lot more prudent, and they've actually been taking more business out of Alberta. But it's still a decent piece of their overall loan book.
Okay, so let's get into specifically Canadian banks. Let's start with that today. We're going to talk about Canadian banks. We're going to talk about U.S. banks. We're going to talk about some names that you like, some stories that you want to touch on. You're going to report to us on People's Corp as well, and anything else that you're watching. So I'll pull up a chart here. This is the portfolio mix at Q2 for 2020 for the six big banks. Okay, I'm going to pull this up. And then you can, I'm not sure if you'll be able to see the numbers, but regardless, it shows at the bottom RBC, BMO, National, TD, BNS, and Commerce. And it's broken down into their exposure, governments versus mortgages, and a few other ones. But the striking, when I saw this chart for the first time, the striking for me was the big number of BMO that has government business, and then the strong presence for Commerce and Royal in residential mortgages. But you're going to tell me there's more to this chart than just that.
Yeah, there is, and that's where the first piece where investors really look to is where are the hot spots of these big six banks and where are the differentials. And as you pointed out, Royal Bank and CIBC have the largest residential mortgage exposure in their books and in Canada as well. Both of them actually have higher exposure in Alberta, which we talked about as well, and that's a hot spot. As we alluded to, and both are very aggressive in that Quebec market. So they're very aggressive underwriters. CIBC did pause a little bit over the last 2-3 years, and that's kind of stalled loan growth, but they're on that path to really get back and be really competitive and to really grow that book. You mentioned the government side, which includes commercial and business, and BMO by far stands out as the one bank that focuses on that business, not only in Canada, but in the U.S. market. And we can talk about U.S. banks afterwards. All the other banks have relatively simple market shares on the commercial side, but BMO focuses on it more, even on the small mid side, which is a bit more risk right now during this pandemic. And the last thing to point out on that chart is credit cards. And credit cards is a great business when the economy is working well. When it's not working well, like we've seen in the past 3-4 months, people aren't using their credit card, so there's less fees. The loan books have shrunk, so the margins are getting hit from that perspective as well. And when the first thing on credit hits, Rob, it does come in delinquencies on credit cards.
Right.
So that's very, very watchful. So it's a very, very high, yielding ROE business. But when there's a credit environment that we're in right now, that is mindful in terms of what to watch in terms of that book and how it translates into relative valuation between these banks. So TD would have the highest exposure on cards, not only in Canada, but in the US, and National Bank would have the least exposure. So more risk at TD near term in our view because of that.
Really interesting, because 5% TD relative to National, so it's 5 times more. You would see a situation, you mentioned that when the economy is not rolling as much, it's kind of the first one to go. So when the economy is healthy, credit card provisions are provision losses or credit card losses for the banks are almost zero, I would imagine, right? I know it's not quite zero.
They're not quite zero. Like mortgages would be like almost zero.
Yeah. Okay, I'm not sure if
like houses, credit card.
Did we lose Scott or did we lose me? I'm not sure. I'm going to keep going here. I imagine Scott's going to come back right away here. Scott, you there?
I'm back. Yeah.
Okay. Yeah, you're good. Yeah. You were saying it's not quite zero. Mortgages are closer to zero, or mortgages would be below 1, right?
Mortgages is below 1. Yeah.
Yeah. And credit cards would be what? The impairments on credit cards in healthy economies?
Low single digits. Yeah. In recessions, it could be like right now, it's kind of in that like 4 to 5. But as we head further into this pandemic and we'll see how unemployment and the rest of the indicators shape out, it could get into the high single digits, low double digit range.
Okay. So TD's got exposure there is what you're getting at.
That's right.
So a lot of the talk around Canadian banks, and you mentioned it, they've suffered. It's been pretty bad. There's an expectation in the market that these bank deferral programs, all the deferral programs are going to, at some point we're going to have to pay the piper, right? I imagine. Mm-hmm. And the banks are going to have to pay the piper. So what's your take on the bank deferral programs and what that's going to look like in the next quarter? And maybe the better question is, when does that hit, do you think?
Yeah, so it's going to start to hit a little bit this upcoming quarter, Rob. So
and maybe Scott, maybe you could just go over what we're talking about when we're saying the deferral programs. Again, we're talking about deferral on debts and stuff. And
yeah, so the government outlined many deferral programs we'll just talk about the Canadian side, the Canadian banks. So for mortgages, which is the biggest piece of the the total book, they gave their clients up to 6 months deferrals on their mortgage payments. So that's the highest duration in terms of the deferral programs. The other programs like credit cards, commercial business are up to 3 months. So it's that latter one, Rob, the up to 3 months that you could see it show up in this fiscal quarter ending July 31st, as a lot of those expired during this month. So we'll really get a good indication on that piece of the book this quarter. And then when we head into fiscal Q4, which is the bank's year end, we'll get a better visibility on the mortgages, and that's more important to the market than and has a more profound material impact on the market than the prior ones.
I followed the earnings closely. I always have. My dad's is a big believer that bank earnings are kind of a good indicator of the economy. We've always followed them closely. I actually did a bit of a piece here on my show after the last earnings season, just with the sheer amount of impairments that the different banks had put on their books relative to losses, relative to expected losses, let's put them that way, and relative to what the street thought they would put. So what are your thoughts on impairment? I know this is already going back 2 months, I guess. What were your thoughts on Q2 fiscal? So that would be kind of Q1 calendar impairments that the bank put for loan loss provisions.
Yeah, so going back to those actual results, Rob, the banks reserved more than actually what the street was expecting and what we were expecting. I think the total number was about 12 billion between the big six. The street was at about 10. So banks like Royal Bank and National Bank reserved a lot more than expected. So just playing a bit more defense and being a bit more conservative. And if you kind of look back at the last little mini oil crisis, they did the same thing, specifically National Bank. Actual losses were actually very, very stable. So they're just setting up all these reserves to cover potential losses over the next several quarters. What's interesting is Bank of Nova Scotia, which is the only bank that has more emerging market exposure. The other big five banks have U.S. exposure. They're the only bank at the time to target a similar provision or reserve build this upcoming fiscal Q3. So with the U.S. banks just reporting, we get a better indication of what to look for with the Canadian banks that have that U.S. exposure. And our thinking is, just looking at the big six that finished reporting just recently, is that those banks with U.S. exposure would have to probably reserve a bit more than what we're expecting right now. So that's what we're thinking, kind of thinking right now heading into the quarter.
Do you think there'll be more provisions relative to equity than there was in Canada on the U.S. side?
Yeah, so I think there'll have to be a bit more provisioning on the U.S. books. So TD, for example, would have 35% exposure into the U.S. market. So we'd have to take a look at that, and BMO would be number 2 at 30%, mostly on the commercial side, and then RBC would have about 18% exposure. RBC would actually probably incrementally benefit a little bit because capital markets was one of the few bright spots of the U.S. banks, in terms of trading and advisory and banking fees, and half of Royal's U.S. business is on the capital market side, so they would benefit a little bit from that. And then CIBC at the low end with private bank is probably in the high single-digit range, so not as material for them, but I think collectively when you look at it, I think our reserve provisioning right now is a bit too low.
I'm going to pull up another chart here. It's the big six Canadian mortgage lending exposure, the percent that is insured versus uninsured. So leading the pack with insured mortgages at 41%, BMO, National 39%, all the way down to Commerce and Royal at 31% and 34%. So this is obviously another risk play that you're commenting on. So 41% of BMO's Canadian mortgages are insured, relative to Commerce only 31%. So I'm guessing this is part of the reason that BMO and CWB are some of your buy targets.
Yeah, it is. BMO's got a high quality mortgage portfolio, but that said, remember their mortgage, they've got the lowest residential mortgage exposure. If you kind of go back to that last picture, so the mortgages that they do, or the underwriting they do, is more high quality than the rest of the group, going more into the insured bucket. National Bank would be in that range too, because half their book, or more than half their book, is in that Quebec market. And because mortgages are typically lower, housing prices are lower, they can take a bit more risk because the balances and basically the price volatility in that market is a lot less than what you would see in, say, the GTA or the GVA in the Vancouver market.
Do you think the loan losses in Canada, do you think the loan loss provisions will be enough? I know that's a bit of a loaded question, but
no, they're going to have to provision more this quarter.
How much more do you think we're going to add? Like another kind of half of what we had in Q2?
Well, we've got a bit more than that right now. It's really tough to say. We haven't really published anything outside of what we did after the quarter, but I would say it's not going to be as high as what we saw last quarter, Rob, but it's certainly going to still be at the high end.
Okay. Let's talk about maybe we should switch gears and chat briefly. Sorry, anything else you want to add about Canadian banks? We'll go to U.S. banks, and we could talk about. Mind you, you've already mentioned BMO and why you like it and CWB. Anything else you want to add on Canadian banks relative? Any of these? Anything that I missed here that I should absolutely be chatting about?
Well, I think the biggest question investors ask me is that are there any banks risk of cutting their dividend, right? And I think before last quarter, we were the only analyst to call out that LB should cut their dividend over the next few quarters, and behold, they did. Which surprised the market, and LB has underperformed. But the
Laurentian
big six,
Laurentian Bank.
But for the big six banks, like even during that worst time during the pandemic, when we hit those March 23rd lows, the banks are well capitalized. And even in our numbers for fiscal 2021, we've got payout ratios, dividend payout ratios on average at 55%. Even in the last quarter, which is the worst quarter we've seen in decades, the banks still earn to pay their dividends. So
and still earn quite a bit more, quite a bit more
to cover their dividends. So
just for our viewers, real quick, Scott, the dividend payout ratio is the percentage of the dividend is relative to your total profit for that quarter. So if you're paying out 55% of your profits, your dividend payout ratio is 55%. So in this case, the banks were at what was the average yield for the quarter? Must have been 5.5 or 6, somewhere around there.
During the quarter is over 6, and now it's just under 6%. So CIBC would be at the high end.
You're generating a 10% return on equity there, and paying out 55% of that. So I think your point is, and I'm not trying to make it, I just want to make sure we understood the dividend payout ratio. Is there's a lot of spare room, there's a lot of spare capital, there's a lot of spare profits before a bank would cut their dividend, I think is what you're saying.
Yeah, and OSFI, the regulator, has like on March 13th, they've told the banks that they can't buy back stock during this pandemic, but they can't raise their dividend, but they can maintain their dividend. Their dividends are very attractive right now. We suspect that OSFI could maybe alter their mind in about a year, and then we would expect the banks, like the big six banks, to resume dividend growth at that time. But it'll probably be at least a year from now.
Okay, this is one of your buys right now. It's BMO. This is a 5-year chart. I'll pull up a 1-year chart here for our viewers, kind of peaking out at about $105. The stock kind of in January, December, fell to as low as, I think it went below $60. Yeah, $55 on March 23rd, $56, and it's now hovering around $75. They did take a lot of impairment provisions. You think it's a healthier debt book with less risk? You think it's a safer play?
Well, I think it's got more upside, the most upside.
More upside. Sorry,
it may not necessarily be the safest play near term, because I said there's the Royal and the National and the TD that are a bit safer. But the Bank of Montreal has got the cheapest multiple up there. So when you see a bank that's trading below book value, specifically a Canadian bank with a prospective ROE in the low double digits, then that's a screaming buy to me on that metric. And even if you look at a price to earnings basis, it ranks cheap. I want to be clear, the sentiment on BMO stock is not great, because every quarter it seems like it has its own hiccup that no one expects, including myself. So last quarter was all the capital market sensitive stuff, in terms of trading losses. The quarter before was like a big restructuring charge. So they've had issues, but if they can kind of control those issues, you'll start to get a good re-rating on that stock, typically where it trades at, and offer a higher total return with a 3-year time period. So it's more of a contrarian pick in this market because it doesn't have a great sentiment. But I think if they can work through those issues, it's got really good upside relative to peers.
Yeah, so it's not a safety play; it's an actual upside play. So
yeah,
thanks for correcting me on that. I'm here with Scott Chan. I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management. I'm here with Scott Chan. He's a CFA managing director here. He runs. He's our financials analyst here at Canaccord Genuity. You've been doing this for about 20 years. So I guess you started when you're like 11 or 12 or something.
Yeah, pretty much. It was one of those prodigy childs. No, typical.
That's a compliment. You look
yeah,
young. That's a
thank you.
compliment. You look young. So it's good to have you on here, Scott. You and I talked somewhat regularly, and recently we talked about U.S. banks. Let's maybe switch gears and talk about U.S. banks for a bit. Their earnings, the mega banks, the big six mega banks reported last week or so, or 2 weeks ago, and they're all done now. That's in the book. So what are your thoughts on the earnings of the U.S. mega banks?
Yeah, so I don't know if the market really cares about earnings too much short term, Rob. But the earnings are actually very good. So excluding Wells Fargo, they all beat by a handy amount. But a lot of it was driven by capital markets, which is is not as repeatable working at Canaccord, right? Every quarter you're starting from ground zero. But a lot of tailwinds in the quarter in terms of trading, iBanking fees, and advisory, basically, hand-holding your clients and collecting a fee during this pandemic. So, in terms of the share price performance of the U.S. banks, it generally performed in line with the market during this time period. The other part of the business is a bit more concerning, which is the actual lending business. The NII trends, loan growth declined significantly. Margins compressed a lot more than what the Street was expecting. And remember, this is the first full quarter where the U.S. went into a zero interest rate environment. So there's several headwinds on its core lending business. And a lot of the market-sensitive businesses, including capital markets, wealth, and asset management, really picked up the slack in the quarter. But it's not really repeatable, specifically on the capital market side.
This is a short-term chart here, 1 month chart of the IYF ETF, which is the iShares Dow Jones US Financial Index. It shows a bit of a bump here after the last earnings were announced kind of a week or two ago. Now hovering still well below where we were in February here, about 25-ish% below where we were roughly in February. So I remember the first earnings came out. I don't know if it was Morgan Stanley, I forget which ones came out, and it was like a home run on capital markets. So the concern is obviously you can't repeat capital markets every quarter. You're not going to get IPOs every single quarter. You're not going to get new issues and secondary offerings. And so I guess that's a concern. But aside from that specific piece, it still wasn't as bad as the analyst has expected, right? Or am I wrong on that?
Yeah, no, it wasn't as bad for sure. So, the capital markets was a lot better than people suspected. So that kind of provided some of the variation to what the Street was expecting. The core lending stuff really came off a little bit. So we talked about some certain sectors that were working before, commercial, business, credit cards. They're all down high single digits sequentially. And remember, the U.S. market is a bit different than the Canadian market. It was shut down for the full quarter, right? Because it's got a different fiscal quarter. And the pandemic seems to be a bit worse there. So if you look at credit, and then going back to our conversation on credit, in general, Rob, the U.S. banks reserved more this quarter than last quarter because the pandemic in the U.S., they're just a bit more worried. So they're reserving a bit more allowances on that front. And that's why I say when I look at the Canadian banks and what we have right now, and with their exposure on the U.S. side, we could see a bit of an uplift on reserves because of what we've seen on the U.S. side.
Do you mean the fact that they're getting 60 to 70,000 new cases every single day in the U.S.?
Yeah, it's alarming. I mean, following it state by state and by regional bank, it's
definitely not funny. I was making light of your point. Last Monday, when we did the Tetrault Show, I was kind of bragging to our viewers and our guests that we had gone 13 days or 12 days without a case in Manitoba, without one case. So like 0 cases for 13 consecutive days. And looks like we got a bit cocky because we got, I think, 7 over the weekend or something. So we're definitely not in the clear here, but it's a lot better, obviously, than 10,000 cases in Florida every single day. So do you think you're going to start to see a kind of divergence of loan loss provisions, U.S. banks versus Canadian banks because of that?
A bit of a divergence. You're starting to see it in this quarter for sure. Last quarter was very similar, right? Because they're just taking their best shot at the start, right, during this pandemic, and it just shot up. But I think it's safe to say when you look at the next few quarters, I think when you look at the U.S. market, it could peak in certain banks like JP Morgan, who's been very conservative. But I think it's very mixed. I don't know if you've seen the high watermark on the U.S. side, and in Canada, I think you have, just based on kind of cases of what you talked about in Manitoba and the improvements that we've been seeing in other parts of the country as well. So I think you'll see that divergence as you talked about, but this quarter would be the widest divergence.
And there's your JP Morgan. It was kind of at 137, 138 right before COVID, dipped below 80, and now it's back up to about $100. Are there any specific names in the US that you really like, or any other regional banks that you really like, or that we got to buy? Canaccord has a buy on right now.
I mean, I don't cover the U.S. banks, but just big picture, looking at the past earnings, like JP Morgan was another high quality beat, gaining market share. That would be the one that people gravitate to, and Wells Fargo could be a contrarian play just based on their, I think they're down 55% and they've cut their dividends. So all the bad news is disseminated in the stock, and I think if you look at going forward, and that's what the market does, you could see a bit of optimism in the business model going forward.
Okay. We had talked also about, anything else on the U.S. side that's interesting that you'd like to add, Scott?
I think one final point just on capital, because capital is so important. And the one thing to note with the U.S. banks, Rob, is that the capital in terms of, the CET1 ratio that the regulators go by was actually up quarter over quarter. So it kind of goes back to that dividend payment stuff and being able to pay your dividends. It seems like there's no risk of further dividend cuts outside of Wells Fargo for the U.S. banks right now because of the strong capital position, which is better quarter for quarter, which is a good sign.
Yeah, my dad used to always say, take it to the bank that they're never going to cut the distributions. Like a Canadian bank will never cut their distribution. So I didn't even ask you that question, but I don't think we could say the same about the U.S. banks because 2008, you recall that story in 2008, how some got really, really beat up bad and some almost didn't survive. So the dividend cut here by Wells Fargo, I don't think was unexpected for sure, given what they're going through down there. Hey, what about international exposure? I know you talked a bit about it a little bit, but can you touch on international exposure for the Canadian banks and what that might mean, one, for the risk and two, for the upside? I know you touched a bit for emerging markets, but
so for the Canadian banks, TD would have the most US exposure, so it's about 35% of the book. This is core retail lending. So if I kind of look at Bank of America, their consumer banking retail was very disappointing. So we think there's higher risk of TD heading into the quarter. One, they're leaving to more slower loan growth on the retail side, on the credit side. They've got more exposure to that shorter end of the rate curve, which we've seen go down to zero. And then in terms of credit, with credit cards and their higher exposure, we could see a higher credit there. And TD's retail segment has just been on the downward trend, but I think this quarter you could see that continue in a material way. BMO is a bit opposite. They're 30% exposure. They're more into commercial, higher exposure into commercial. And commercial is at risk too, Rob, because if I look at the U.S. banks, you had about 8% sequential decline after.
Okay, I may have lost Scott again, or maybe it's me. He was talking about the decline. Scott, you there again? You back?
Yeah, I'm here.
Yeah, sorry, cut out there for a bit. So you either could pick that point up again if you'd like, or I was going to ask you about loan growth.
Yeah, I think I was talking about TD. They had the highest exposure, 35%. Retail, a lot of it's the personal side, like Bank of America. Bank of America disappointed in the quarter in that regard. So slower loan growth, as you kind of just talked about. And then just a lot of NIM compression. And then in TD's case, they've got the highest exposure to the short end of the curve. So when rates dropped, like we've seen US go to zero, they're highly susceptible to have further margin contraction. And then when going back to our credit card talk, TD's got the biggest exposure in the US as well. And credit cards are more risky. And you saw banks like Bank of America set up more allowances in the quarter. So looking at the bottom line at TD's U.S. retail, we could see risk over the coming quarters, including the next quarter.
Okay. We were going to chat on loan growth real quick, but I mean, you talked about it already. Anything you want to add there on the growth of the loans for the banks?
Yeah, the one weird bright spot on loan growth during this pandemic is residential mortgages, right? And you saw that in the U.S. and you're seeing that in Canada. And typically, when you have a recession or a real recession, housing prices aren't up, and residential mortgage growth, is not up like we've seen lately. So that's very interesting to point out on the loan growth side. But every other category, when you look at it, has been down meaningfully over the last 3-4 months. So we're talking about credit cards, commercial businesses, home equity lines, auto, but residential mortgage has been a bright spot, and it's the largest exposure too in each book. So it's actually helping protect the overall size of the book in these banks.
Auto just about stopped there, for a month or two.
Yeah, it's stopped completely.
Stopped.
Yeah.
I have a few friends that are in the industry, and it was tough times. Let's take you through. Sorry, anything else you want to add on U.S. names or anything specific on U.S. names that you'd like to add?
No, I think we're good. Yeah, I just want to talk about capital.
I'm going to ask you. Yeah, let's talk about People Corp. You put out a research note today, and the results I believe were slightly above expectations. So you wrote this and you just kind of released it today. It's a research alert that I got. So we have a target on this stock. Full disclosure, we have a buy rating. We have a buy target on the stock of 11.25. By the way, don't take this as investment advice. We don't know your situation. We don't know what you're doing. If it's something you want to discuss, please go to www.speaktorob.com. I'd love to book a no obligation consultation with you. You can go to my website, robtetrault.com as well. But again, this isn't advice. This is Scott giving us his take on the quarter, the results of the quarter. So earnings were above expectations. I think the revenue came in at 53 million. Consensus was 54. How did the rest of the quarter look?
Yeah, so revenue was a touch light. The real beat on the bottom line and on margin was on the cost side. And with a lot of financial service firms out there, Rob, a lot of the costs related to travel and expenses and entertainment have come down materially. So that contributed to the better quarter. And then with the slower revenue profile, or a slightly lower revenue profile relative to our expectations, variable comp was came in a bit lower than we were expecting. So I think overall it was more in line because some of these costs will come back. But nevertheless, when you show almost 5% organic sales growth during the worst 3 months that we've ever seen, that's a positive sign that your business is very defensible. These guys have got a 5 to 10% organic growth target, and have always exceeded 10%. And the real juice to this story is that they've been a serial acquirer over the last several years. And I think if I look back the last 3+ years, they've made at least 4 acquisitions each year. Although the acquisitions have paused, management did talk about today that their corporate dev team is starting to look at files as the pandemic is improving, and incremental growth, accretiveness on acquisitions, potentially better deals could surface as a result of this. And this is a company with a solid balance sheet, a lot of cash. They've got almost 100 million on the credit facility that's unused to help support future acquisitions. So I don't expect anything over the next few months, but if acquisition activity normalizes, these guys are well positioned to outperform the market, or to continue to outperform the market.
You've been following this one for a while, if I recall, right? Several years?
Several years, yeah.
Yeah. And this is a Winnipeg story. For those of you who don't know, I used to work with a fellow by the name of Dennis Stooner, fantastic guy who's over there now. I believe he's a really smart guy, one of the greatest guys I ever got to work for. A really neat guy. So he's doing some good things over there. So the target's 11.25. Was this a bump on the target, or is this still the same price?
It's still 11.25. We're still working on it right now, like today on it. But yeah,
you'll keep us posted for sure.
Yep.
There's other couple other names maybe that you'd like to talk about real quick, or I know you had talked about Onyx.
Yeah, I mean, I always like to break up names that I get a lot of interest from, not only from Canadian clients, but US clients. And Onyx comes to mind. One, because it's the only financial stock that I cover that is actually down since June. So I think it piques a lot of people's interest when you kind of see that that difference relative to peers. Onyx is a large private equity firm. They do credit and they do some real estate as well, but predominantly it's a private equity firm. Right now when you look at Onyx, the biggest headwind to the stock, Rob, is you talked about airlines earlier. They bought WestJet last year in December, and
Right.
the timing obviously wasn't great. Although it's probably only 3% of their NAV, the sentiment is, the investment sentiment is not great towards that investment, especially buying a public company at a 60% premium in a private equity fund. So it's still early in the fund. It's still early in WestJet. It's going to take a long time for the airline industry to come back, and they're doing a lot of things behind the scenes. But I think that's the real kind of thorn in the stock in terms of why it's underperformed so much. I think taking step back a bit, this is a company that's got no debt. It's got $2 billion of cash, so 35% of its NAV. So they can take advantage of all these new opportunities in the market that have come up, especially on the private side. So investors with a good medium-term perspective, we think it's got a lot of downside risk, and certainly upside risk. More upside risk if investments like WestJet and the like Gluskin really come to fruition.
Or their book would WestJet be?
What would their book at WestJet?
How big is WestJet relative to the market cap of Onyx?
It's like less than 3%.
Yeah, so
it's not too material, but it's just the sentiment surrounding it is really impacting the story.
$100 stock, just a year or so ago, just over a year ago, and it dropped to $40 in the pandemic. Dropped almost $60 from 90 to. So that's a significant drop. It's kind of bounced back a little bit now. It's at 60, still well off its highs. Interesting chart for sure. Aside from Onyx, you mentioned People Corp. You got a buy rating on it. Anything else? Any other names that are interesting? Everyone wants to talk about Canadian banks. You said they're not cutting their dividend. You said some interesting things. Some of the riskier plays, some of the safer plays. Any other stocks, names that you like and you follow?
Yeah, I think Sky Financial is interesting. They've got they had a new CEO come in last September, Kurt McAlpine. All the traditional asset managers have turned to the U.S. to lead the company. So you look at IGM, which is Winnipeg-based, hired Jeff Carney, and then you look at AGF, hired Kevin McCready from the U.S. market. CI is a stock that really had great momentum leading up to the pandemic, and a lot of it was with their acquisition strategy in terms of wealth management, particularly. And then also expanding its product base through partnerships. CI, as you probably know, has a lot of traditional mutual fund product, and a lot of these companies want to diversify into liquid alts, alternatives, private equity, and CI has done a very good job in that front. From a wealth management standpoint in Canada, they own Asante, which is one of the top independent advisory firms in Canada. And then with the new CEO, Kurt, they're really expanding into the U.S. RIA market, the wealth management market, which is a very profitable business, especially if you can buy a lot of these and consolidate and scale it up, and then put some local CI product there over time. So since he started, they've done 4 acquisitions in the U.S. RIA market, totaling about $9 billion of AUA. So kind of half of what we already have in Canada. With a significant pipeline over the next few quarters. So RIAs trade at significant multiples. And if you look at CI's valuation right now, it's still trading at trough valuation multiples because it hasn't rebounded to a certain extent like an IGM has since the pandemic started. So, you get a company that's trading at less than 8 times earnings. You get a good dividend yield of 4 to 5%, closer to 4%. No risk of that being cut. And you get an interesting strategy going into the U.S. market with some smart guys that have very good experience in that platform.
Really interesting stuff. CI was the call right there. Oil today closed up 16 cents to 40.75. As I mentioned earlier, NASDAQ had a fantastic day, up 263 points to 10,767. The S&P 500 up 27 points, and the Dow Jones up 8 points TSX up 60 points, closed at 16,183. That's a nice number. It's above 16,000. That's it for the show today. We're going to wrap it up. We're going to thank you, Scott. We're going to thank our viewers for tuning in. We'll definitely do this again, whether it's maybe early next year or late this year. You're a fantastic mind. I like being able to just pick up the phone, give you a call, ask you about stocks, about financial companies. You're always willing to help me, so I appreciate that, Scott, and I appreciate you. I thank you for taking the time to come on the show. If you're watching on YouTube, take a second and subscribe. We need to get to 2,000 subscribers. We might have got there today. We're really, really close, Scott. If you're watching on Facebook, please take a second and follow and share and like. And if you're watching with your parents, tell them to tell everyone they know or whoever. We're thankful for you guys for tuning in. I'm Rob Tetrault from robtetrault.com, portfolio manager here, Canaccord Genuity Wealth Management, and the Tetrault Wealth Advisor Group. If you'd like to book a no obligation consultation, please reach out to www.speaktorob.com. And thank you so much for tuning in today. Have a great day, folks.